Okay, thanks everyone for joining us today. Today we're going to be running through tax planning. So my name's Jo. I'm an Associate Director in the accounting team at BlueRock. We're a multidisciplinary professional services firm. Today we've got accounting and private wealth with us. We've also got amongst our group bookkeeping, self-managed super, grants and incentives, finance, digital, general insurance, law, places, and entertainment, media and technology. We really pride ourselves on taking a practical and commercial approach and providing an educational environment, not just for ourselves, but for our community as well. As part of that, we've been putting on our Wednesday webinars. So today is obviously tax planning. Next Wednesday, the 3rd of June, we've got capital raising in a COVID-19 environment. The following Thursday, the 4th of June, we've got On the Culture Couch, which is also going to be including special guests Paul Roos and Jared Murphy. And Wednesday, the 10th of June, we've got estate planning for a secure future. So today I'm lucky to be joined by two of my favourite resident rock stars. So I've got Danny Zaffino, who's representing Private Wealth, and Danny's one of our financial advisors. I'm also lucky to be joined by Mitch. Mitch Hancock's one of the directors in the accounting team. So they're going to be providing some help along the way today. So this year we're embarking on tax planning a little later than usual in order to encompass the unstable environment and the relief measures available in relation to COVID-19. So today I'm going to kick off with Mitch. So Mitch, why is tax planning an important exercise and how is it different to year-end compliance and tax returns?
Thanks, Jo, and welcome everyone. I think just generally there's a bit of a common misconception when it comes to tax planning, and it's something that can be done sort of after 30 June, and to be fair, it's probably something that was done for a long period of time. And I guess if you're leaving it till this date, it's probably too late now. You've got tax planning really being, I guess, the strategy piece, how you plan and execute. Whereas compliance work is just documenting really what's already been done. If critical things such as getting money into super, purchasing assets, writing off assets, setting up new entities, or just documenting trust distributions and those things, all of those need to happen pre-30 June to be effective.
Yeah, thanks. So often, Mitch, you'll obviously be looking more from the business perspective. And Danny, so from your perspective, why is tax planning important and how do you go about it with your clients, more from the personal sort of world?
Yep. So I guess from the personal world, there are constant changes in legislation, especially with regards to areas like superannuation. The government seems to like to change their mind very often about what you can and what you can't do. So with those constant changes, I guess we really want to take advantage of those opportunities as they come along. And tax implications on any sort of investment strategy can make a large difference to the end result. So as Mitch mentioned, planning beforehand is definitely a must. And having key information on hand to be ready for that tax planning piece is definitely important. So I guess as a part of our process with regards to personal planning, we usually touch base in May or early June to organise a meeting or a phone call to start discussing what strategies might be available. And I guess as a part of BlueRock, we may hold an internal meeting beforehand across different divisions that may be involved in those sort of conversations. And we really take a team approach as to try and work out that personal strategy, which may link into business strategies as well. So across self-employed people, there might be some conversations between a couple of different departments, depending on what the business situation is and what the personal situation is. And then also for those non-business owners, it's also really important to go through a tax planning strategy session. Gathering information like pay slips, superannuation contributions and balances and those sorts of things, definitely still important, and strategies can be discussed off the back of that information as well.
Awesome. And so, Mitch, I understand with our clients, we've got well trained and they're used to going through the tax planning motions with us every year. But what if I've never done tax planning before? Like where do I even start?
Yeah, absolutely. There's definitely a bit of a discovery phase that needs to go into it. I mean, Danny's just touched on the personal elements of tax planning, but I guess it's important to start with the group structure and including all of the entities, whether they're dormant, corporate beneficiaries or individuals and the wider family group, to understand who we're dealing with and I guess making sure we're having a holistic approach to the whole piece of work. And secondly, I think it's really important to start with an accurate P&L forecast. Needless to say, tax it's an income-based tax we're talking about. So without understanding your profit and therefore taxable income, you haven't really got to the right place to begin with. So definitely understanding that. And I guess it's probably harder now than ever, but again, really important. And that's why the time is critical as well.
And so when dealing with our clients that we like to think are nicely well-trained by now, what's the ideal process that you'd go through with them?
Yeah, definitely. So we've obviously already got all the information at hand, which is great. And I guess for a lot of our clients, just given everything that's going on with the climate at the moment, we've already been forecasting P&L, some of them weekly. So we've really got a good place to start there in terms of where we think the business is going to land from a profitability point of view at 30 June. And I guess that gets us off to a good start, but you can't, I mean, the key message there is you just can't get to your tax planning piece without actually understanding your P&L and first and foremost.
And so when it comes to timing, when is tax planning most effective?
Yeah, look, I think you touched on it earlier that we'd probably do it a bit earlier than usual. Now it's thrown out a little bit, everything that's happened with COVID-19, but I think we'd typically start the process in April, and then particularly for really sophisticated groups, have a lot of planning done by the end of April. But I guess having a bit more of a known quantity this year and doing it sort of late May, early June will mean that we only have to forecast maybe a month to two tops, and gives us a bit more of our data in there that's actual to deal with. I guess doing it now as well is important pre-30 June. I highlighted a few of the things that you actually need to do pre-30 June to be effective, but also having it done before you get to the June BAS. And there's credits of installments that have been paid in the past that you can actually get back and help support cash flow, but then also understanding what's the tax left over to pay and when do we need to pay it, but also having an opportunity to credit back any tax you thought you might have to pay as part of the June. So there's a real cash flow element here, which is more important than ever.
Absolutely. I think the biggest thing we're saying with clients at the moment, cash is king. It's in this particular environment. So is there anything in particular in terms of strategies businesses can look at to obviously legally minimise their tax?
Yeah, I mean, some really basic ones for business is obviously reviewing your stock on hand. A lot of businesses that carry a lot of stock. I know we're dealing with a lot of clients who had a bit of a surge in purchasing through March, for example, and holding a lot of stock. So reviewing your stock, can you write it off? Is there anything obsolete? Can you change your valuation methodology at 30 June to get a better tax outcome? That's all above board. Reviewing things like trade debtors or other assets you can write off. Some of those things need to be done prior to 30 June to be effective.
Yeah. And in terms of purchasing new plant and equipment, I understand there's been a few changes recently. Can you just run us through those as well?
Yeah, there's a really key one there that the instant asset write-off for small business has gone up to $150,000 per item. It seems crazy. Maybe a lot of people are thinking, how could you possibly be going out and spending that sort of money on capital expenditure? But there's definitely businesses out there that are looking to take advantage. That has actually gone up from $30,000 as at the 12th of March and will go down at this stage to $1,000 at 1 July. So really important to take advantage of that if you can. And then also just being sure that it's installed and ready for use is often an easy one that you can trip over. You bought the asset or you've got the invoice, but it actually needs to be installed and ready for use pre-30 June.
And then given the nature of the current business environment with COVID going on, what are some of the things to look at for planning opportunities for clients this year that are pretty unique?
Yeah, definitely. I think there's a lot of clients seeing tax planning and saying, well, my business is taking such a hit, why would I actually need to do it? But without knowing that there's obviously the state government grants, there's tax refunds, there's the JobKeeper payments, and the pay-as-you-go withholding cash boost. They've all got, they might have slightly different tax treatments, and we've seen that a lot of those payments coming in have actually pushed businesses or they thought they were going to have a significant loss, and all of a sudden they're dealing with taxable profit. So you need to be very cautious of that and make sure you're on top of it pre-30 June. There's obviously, I mentioned before, crediting back large tax installments paid and the opportunity there from a cash flow perspective. But then also the ATO is being very generous just generally around extending payments, and there's a specific 4-month deferral on any of the things like income tax, BT, activity statements that you can take advantage of too.
Yeah. And I think with a lot of the deferrals and that sort of thing, it makes it even more important to have that cash flow forecast and that in place as they start to unwind, and you do have to continue to make those commitments and that sort of thing as well. Another common one is around business structures. Are there any opportunities to change the structure prior to 30 June to save on things like tax?
Yeah, certainly. I think a really common one is, you're trading out of an old structure like a partnership or a trust, and they definitely can be effective. There's a lot of reasons why you might do that. Generally speaking, I mean, those sort of entities can't retain their profits, so you might have a lot of the business profits actually going out and taxed at an individual level at 47%. Whereas the small business or the base rate tax for companies is now down to 27.5%. So there's such a big gap there. There's often an opportunity to restructure pre-30 June and take advantage of that. But again, it's something that probably needs to be done well in advance, and you need to give yourself time to get it set up, get the advice from that and everything else.
Yeah. And so making sure that we're focused on having the right structure for businesses, I guess, is one part. But moving over to you, Danny, how about in the personal world? Is it that relevant for the areas that you look at?
Yeah, so absolutely. When you're talking about an investment strategy, I guess you've got the actual returns as one aspect, and then the ownership structure or the tax outcome is basically just as important as that return aspect. So the end result, for example, if you had an investment strategy and you made a $10,000 profit, if you've got to pay half of that back to the taxman, then that's obviously severely decreased that investment's return. So making sure that's housed in the most appropriate tax environment is definitely important. And I guess as a part of any investment decision making, that's where we'd like to work in conjunction with our accounting team. So firstly, with the ownership strategy for the investments, depending on the type of investment, whether it's a capital growth investment or maybe an income producing asset, that's where the accountant can then determine what's going to be the right entity to use for that sort of investment. And then also speaking to our finance team and looking at a debt strategy for those investments. So whether we can set up the debt in the most tax effective manner, and if it's a more complex strategy that uses interlinked entities and those sorts of things, holding the debt in the right structure can also make a vast difference to the investment strategy overall. So those are some of the considerations that we would definitely take into account for a personal investment strategy when it comes to tax planning.
Yeah. And I guess one of the things that we're noticing in the current environment is that obviously asset prices are really bombing. With that also comes some opportunities. What sort of things do you recommend looking at?
Yeah, definitely. So as you mentioned, in particular in the Australian share market, prices have decreased considerably since the start of this year. So it provides a couple of opportunities there. So one that springs to mind is a change of ownership structure. So usually upon the transfer of an asset to a different entity, you would need to consider the capital gains consequences of that decision. And I guess with the lower prices in the equity markets, it may be an appropriate time to consider a move in entity, considering that the capital gains event may be less than what it was previously. And as an example to that, if you were closer to retirement, you may consider transferring assets into superannuation. And in some circumstances, you can do that by transferring the actual shareholding via an in-species transfer into your super fund. So depending on your super provider and structure, that may be an option that's available to you. And then another couple are, so utilising an offset account. So as we're speaking about opportunities, with the interest rates at this point in time on a savings account, probably not going to get that much of a return from them. So an offset account providing greater value than those savings accounts, and the fact that it's tax-free, again, sort of a win-win scenario there. And then another one that we're seeing at this point in time is contributing to superannuation. So given that it's concessionally taxed on the way in, and it can be concessionally taxed on the way out, again, You can take advantage of the lower prices in those equity markets if you have a long-term mindset, plus get a little bit of a tax advantage of putting the contribution in.
Nice. And so broadly, can you run us through how you can contribute to super?
Yeah, so there's two main types of contributions. So the first type is a concessional contribution or a before tax contribution. So that's the one where you can make a tax deduction for putting the contribution in, and that's limited at $25,000 per year. And the second type is what's called a non-concessional contribution or an after-tax contribution, and that's got a limit of $100,000 being able to be contributed each year.
And so, Mitch, super is another one that often gets raised from the business perspective. Do you have any tips around this?
Yeah, so I think we obviously work closely with Danny in the wealth division around where those contributions are being made effectively. There's a tax consideration, but there's also definitely a cash flow and a personal wealth consideration there. So we'll often work with them closely to say how much cash is coming out of the structure and where are the opportunities to make the contributions and help execute on that together as a sort of a joint strategy.
Yeah, nice. And so, Danny, how do self-employed and employees each make concessional contributions?
Yep, so there's a couple of different ways which contributions can be made. So for those self-employed clients, I guess not having a guaranteed 9.5% going in if you're not on a salary, that's an area that we often see with business owners. That's an area that's sometimes neglected. It's something that we, as Mitch mentioned, we like to discuss as a part of the business strategy and then personal strategy where the contributions can be made. So those self-employed people have the option to put them in continuously over the year or to make a lump sum at the end of the year. And for an employee or someone that's not self-employed, there has been a recent change to legislation, which means that employees can now also take advantage of making a lump sum towards the end of financial year. So previously, you could only make extra contributions as an employee via a salary sacrifice arrangement with your employer, and that's now changed so that an employee can make a catch up at the end of financial year. So if cash flow is a bit of an issue within the personal world, you do have the ability to catch that up closer to the end of financial year.
And depending on where people are at, cash flow is obviously a big part of having the funds available to actually get it into super. If I've sort of had super a bit on the back burner and I haven't used the full caps each year, can I make up any catch-ups for concessional contributions?
Yeah, absolutely. So there has been a few changes to legislation in recent years, one of them being what's called a catch-up contribution. So if your super balance is under 500,000, you have the ability to catch up missed contributions from previous financial years, starting from the 2018-19 financial year. So you've got the ability to catch up 5 years in one go. So at this point in time, considering the legislation was only recently passed, if you haven't made any contributions last financial year or this financial year, you'll be able to contribute up to $50,000 as a before tax contribution. So I guess as we were sort of speaking about all those self-employed business owners that maybe hadn't considered contributions in the past, you've got the ability to catch up those contributions if you can't make them for business reasons or for personal cash flow reasons.
Yeah. So is this a strategy you're particularly looking at for this year? And I guess what sort of circumstances does it really suit to be able to do these catch-up ones?
Yeah, so again, as you sort of mentioned, cash flow is king. So, largely these strategies are determined on the cash flow position of each individual. But I guess in the current environment, with the ability to make those catch-up contributions, one important thing to consider is that the tax deduction for that contribution is applied to the tax year that the contribution is made. So that's where you can start to get a little bit strategic and maybe thinking about the business revenue. In the current environment, if the revenue is going to be lower, you may consider maybe holding off those super contributions for this financial year. And maybe as the business ramps up again next financial year, you might consider catching up your contributions for the last couple of years and then also making that deduction in the year where your business revenue is higher. And the other one to consider from a personal aspect would be if you have any capital gains tax events. Again, you may consider if you've, for example, got a sale of a property and you've got a capital gains tax event, you may consider putting some of the proceeds into super to decrease those tax obligations, but also boost your superannuation balance as well. So that's something that we're looking at this year and looking into next year about being strategic with those catch-up payments as well.
Yeah. And so we've sort of covered off on the concessional contributions. What are some of the opportunities with regards to the after-tax or the non-concessional contributions that you're looking at?
Yeah. So with those after-tax contributions, so your normal limit is $100,000 can be contributed each year. So there is what's called the bring forward rule, where you have the ability to make 3 years contribution in one go. So you can make a $300,000 contribution to super all in one go. So we usually see this strategy utilised by people that are closer to retirement, and it's important to know that age 64 is the final time that you can utilise that strategy. So timing that contribution is important and something that we'll always consider as a part of tax planning. And a couple of other considerations are, so if you're a couple and you've got different ages, you may consider which person you utilise to make that contribution. So if you've got an older spouse that's maybe closer to that retirement age, you may consider contributing to their super fund, knowing that you'll have access to the funds quicker. And then another little tip that you may want to use is that with the contribution, it can be made any time in the financial year. So you may have the ability to make a $100,000 contribution in June, and then you can actually make the $300,000 contribution in July in the next financial year. So effectively, you're putting in $400,000. It's across 2 tax years, but you can do it in quite quick succession. So that's a little tip of how to utilise that, how to utilise that legislation in your favour. And I guess another of the after-tax contributions, which has come about from a recent legislation change, is the downsizer contribution. So there are a few criteria that need to be met for this one, but basically it's for a person that's over the pension age. If they sell their main residence, they have the ability to put an amount of $300,000 into their superannuation. So typically you can't contribute to superannuation after you've retired and you're past pension age. However, this is one of the changes that's recently been made to give the ability for age pensioners to be able to put some money into the superannuation environment.
Nice. So another really common scenario that we come across is 2 people in a relationship with really different levels of income. Are there any strategies around that? Yeah,
so there's 2 main strategies that come to mind when we're looking at spouses with differing incomes, and these are both after-tax contributions. So the first one is called a spouse contribution, and you may consider this for a non-working or lower income earning spouse. So the threshold is around about $37,000. And you may even consider it for a spouse that's on mat leave, as an example. So what you can do there is you can contribute, the higher earning spouse can actually contribute to the lower earning spouse's superannuation fund. The maximum contribution is $3,000. And then the higher earning spouse can actually claim a tax offset up to $540 for making that contribution. So, something that has been an issue in Australia is that women may have a lower super balance because of, taking time out of the workforce to raise a family. So this is one way to sort of keep that superannuation growing during those years where they may be working less. And another option is the government co-contribution. So again, for a lower earning spouse, you have the ability to put in $1,000 after tax. And depending on the criteria, you can receive a co-contribution from the government up to $500, also added to your superannuation balance. So there's 2 little strategies that are available there that will, one can save you tax, and the other one can put more super into your balance without you having to do anything. So there's some of the things that we definitely think about when we've got income levels that are different in a relationship.
Yeah. So we've spoken a bit about getting money into super. Has there been any recent changes or tips with regards to withdrawing from a pension?
Yeah, so again, amid the COVID-19 situation, there's been a couple of changes with regards to a pension. So just quickly, how a pension works is that once a pension has been started within a superannuation account, there's an amount that must be withdrawn each year depending on your age. So as an example, if you're aged between 65 and 74, the minimum amount you must withdraw is 5% of your pension balance, and that's now been halved to 2.5%. So again, when you're considering pulling money out of superannuation, if you maybe had assets that are in a different tax environment and maybe more, may not be as tax effective as super, you may consider using those assets to fund your lifestyle, so that you have the ability to keep those assets in your pension in that tax-free environment and continuing to accumulate over time. So that's one thing, particularly for this financial year, that we'd be looking at with clients. And another one is pension structuring. So as we mentioned, those after-tax contributions, you can actually get a little bit strategic with starting a pension and also withdrawing a pension. So you can actually have multiple pensions. You don't just have to have one superannuation pension. And I guess if you're considering a large after-tax contribution and you're close to retirement, you may consider a few different strategies that are available with starting pensions. There could be a huge tax difference upon passing assets to beneficiaries. So as a part of your estate planning considerations, you may consider the structures that you're using for your pension to be able to make sure that your beneficiaries don't pay too much tax upon the eventual passing of assets. So that's an area that we'd also definitely be looking at as a part of this year.
Sounds good. Now, one that's created a few hot topics around our office, it is seen as potentially a little bit controversial, is one of the current COVID relief options is for eligible individuals to withdraw up to $10,000 of super prior to 30 June and another $10,000 prior to the 24th of September. What are your thoughts on this, and what are some of the things that people need to take into consideration?
Sorry, Joe, I might have missed out a little bit there. Was that around the $10,000 withdrawal?
That is. So I've said it's a bit of a controversial one. I definitely know your opinion, but
yep.
I thought maybe you'd like to share that, and what are some of the things that people need to take into consideration?
Yeah, so with regards to that legislation change, we think about this in sort of twofolds, and that's around what is the, what's the importance of utilising that money now compared to the possible future detriment to your superannuation balance. So it's just weighing up your pros and cons with that. So as a part of all the stimulus measures that have come out of COVID-19, this is one that we sort of see as a bit of a last resort, knowing how that can impact you over the long term. So as an example, we'd encourage you to utilise, there's actually a calculator provided by MoneySmart, where they've got a calculator which can determine, based off your super balance now and then your age and income, what your super balance may look at retirement. So we've actually run an example scenario for this situation. So for a 35-year-old with a super balance of $100,000 that retires at age 65, if you take out $20,000 now, so the highest legislated amount, that actually equates to a difference of around about $40,000 by the time you get to your retirement. So, thinking about the importance of the funds now and then that future implication is definitely something that we'd encourage. If you're going to use those funds to maybe buy a fancy new car or a new TV or something like that, then we'd want to consider what's that future detriment going to be to your superannuation fund.
Nice. And so we're sort of coming to the end of the material that we wanted to cover before we move on to a few questions. One of the things that we really love about BlueRock is being able to collaborate between divisions to make sure that our strategies and that are well covered off from a number of perspectives. Do you have some examples where collaboration between divisions has worked really well for some of your clients for tax planning?
Yeah, definitely. So Mitch and I actually have a client together that we've got a meeting booked for next week. And with that client, we're going to have 4 advisors sitting in the room there. So we've got Mitch and the accounting team looking at business cash flow. Then we've got the private wealth team looking at superannuation contributions and an investment strategy. We've got the self-managed super fund team in there completing their compliance review for the end of financial year. And then we've got the law team generating a lease agreement as a part of their business and personal strategy. So I guess having those 4 heads in a room and your sort of team working together just creates a lot of synergy and effectiveness with getting strategies together. So, the time saving of, trying to get those 4 people to intertwine and collaborate is definitely something that we think is a great value add for BlueRock, rather than the client having to try and get those 4 people to collaborate. And then also off the back of those sort of discussions, being able to implement those strategies swiftly is something that we can all do off the back of having that discussion together. So having that sort of team working together just reduces the time for firstly the client, but also the advisors to try and all become aligned to what the strategy is from an overall perspective.
Nice. And Mitch, do you have another example of one of your clients where the collaborations worked really well?
Yeah, I definitely echo Danny's thoughts there. Probably just having those people in the same building, or maybe not the same building right now, but having us all just working together for one strategy is probably cuts out 100 emails plus, but also where we can execute quickly. And I think that's the really important thing here with tax planning is, there might be an idea that comes up or a strategy we want to implement, and it's late May, early June. And some good examples there are some clients that want to take advantage of the stock market where there's lower prices, and they'll quickly come to us and understand what's available cash in the business structure, and that might involve a bit of forecasting, and then they'll take it away and say, well, we've got X amount to play with, and we want to put so much into super. So definitely a lot of interaction with the wealth team at the end of the year. But similarly, if we decide, I mentioned earlier about restructuring, and if we say that there might be a new entity that needs to be incorporated, we might be selling assets from one entity that we control to another, quickly going over to the legal team and working together to get the legal agreements in place under some sort of rollover or restructure, and being able to turn that around in a couple of weeks, where we might have lost that opportunity if we were working with externals. So there's definitely a lot of benefits to us, even while we're not all in the office together. It still works really well.
Nice. And Danny, have you been dealing with many new investment strategies within this year's tax planning?
Yeah, definitely. So as Mitch sort of mentioned there, with the with the large decrease in the Australian stock market, especially over the March period, I think all financial advisors have seen a lot of activity with new accounts opening and those sorts of things. I believe the ASX actually reported it's been the busiest time of year for share trading off the back of that downturn. So yeah, definitely a lot of opportunity for investments. And I guess as a part of echoing what Mitch mentioned around entities and optimal structuring, I guess as a part of that investment discussion, we're definitely having a lot of discussions with our accounting team and also our finance team. So firstly, to get that entity structuring right, get the debt structuring right where we can, and then get the investment structure right as well. So we've sort of ticked off all 3 of the main areas that we need to tick off on to get that 3-pronged attack for future success.
Mm-hmm. So yeah, the collaboration piece for us and for our clients is massive. As you can see, it really does work really well, working so well together. Danny and Mitch, I've really appreciated all your insights today. We've got some time for a couple of questions. So if people don't mind popping their questions into the Q&A, I can run through a few of those, so we've got a bit of time and the boys can answer them. So the first question that's come through from Gary. So do you have any tax minimisation strategies for the businesses that have seen really good growth through COVID and have some spare cash aside?
Yeah, certainly. I think particularly around the instant asset write-off, things that we can purchase. Are there things on the balance sheet that need to be written off? But also, again, there's those contribution strategies. There might be things that 6 months ago we weren't thinking about doing or investing in that actually create a tax deduction, but now there's been that growth. There's probably some cash sitting there. How can we take advantage of that? I don't know if Danny, you had anything to add to that?
Yeah, I guess around, possibly making personal concessional contributions. That's always, depending on the cash flow of the business. Looking at areas to tax effectively convert business success into personal wealth success. Whether that's a personal investment strategy or a superannuation strategy, those are two things that sort of spring to mind with those that are performing quite well in the COVID environment. That might be a consideration there.
Yeah. And I guess one of the benefits of having the multiple divisions collaborating with us and also watching our webinar at the moment. So George, our head of super, just wanted me to point out in relation to the $10,000 super withdrawal, the ATO have specifically come out and said, don't withdraw it and then put it back as a personal concessional contribution, which I know the guys in my team were pretty quickly onto when that came out. So auditors for self-managed funds are being asked to report where members have taken out that 10,000 and made personal concessional contributions again to chase that tax deduction. So definitely not something that we would be recommending. And as Danny said, it's working out what's right for your circumstances and what you're actually going to use those funds if it's right for you to take that out. So another question that's come through. So given I can get a nice big fat tax deduction using the instant asset write-off of the 150,000, should I be heading out trying to purchase new assets before 30 June?
Yeah, it sounds like an attractive option, doesn't it? A bit of kit before 30 June, but I guess the way to look at it is always, you need it. The strategy is, you might get just under a third of it written off on tax, but you're still out of pocket for 2/3 of it. And so I guess if it's something that you're looking to get and it's a need and it's a growth strategy for the business to have that asset, then absolutely. And maybe it's bringing that purchase forward, but certainly not going out and just buying things for the sake of the tax deduction.
To sort of echo Mitch's thoughts from the personal side of things, do often see those sorts of tax incentives, maybe promoting a bit of behaviour that maybe consumers wouldn't do. So, for example, with things like buying new cars or having them on novated leases, great from a tax perspective. However, also need to consider the cash flow implications of purchasing new assets and those sorts of things. So, on one side there is the tax benefits, but as Mitch mentioned, is there the need for that asset? And what's the opportunity cost of maybe not utilising those funds for those those types of assets, and maybe other assets that are more growth orientated or provide a long-term value.
Yeah, I think that's a really common one that we get asked as accountants. It's like, oh, well, I can claim a tax deduction on it. Should I go out and purchase more things just to get the tax deduction? And as the guys have said, well, yes, if it's something that you're intending on utilising anyway, but spending money for the sake of getting a tax deduction, you're still out of pocket. And so, Danny, in what you've seen with the $10,000 super withdrawals, have you seen any clients taking that out and then using it to purchase shares at the moment, given the market?
So it's not a strategy that we've seen too much within our client base, but I know that for people that are possibly looking to maybe purchase their first home, that's something that some people have been considering. So having access to your super fund, bringing those funds into your personal world, knowing that trying to enter the property market as a first home buyer is quite hard. So some people have been using their superannuation to help with gaining a deposit in that area. So again, most of our conversations are around what's the use of those funds, and will they generate a return for you in the long term? So taking money out to purchase growth assets like property or shares, that could be a good strategy, but also, just want to take into account what is the long-term effect that could have on your superannuation if you do it. So sort of referring back to the example with the Money Smart calculator and looking at the end effect to your superannuation balance, the younger you are, the bigger the effect that taking the money out is going to have. So just want to keep a holistic mindset with what could happen with those funds.
Nice. And another one we commonly get asked is like, what is the best structure for operating your business? Is it always a company?
No, it's certainly not one size fits all under that. I think we mentioned just cap tax rates and how that can be effective from a tax point of view, but there's a lot of legal and commercial considerations as well that need to go into it. It's also important to know that if there's an asset that you think might be sold in there in the future, I'd say goodwill within the entity, that a company doesn't get access to the 50% CGT discount either. So a lot of planning that needs to go in, and what is there an exit strategy there for the business? Who else is involved? Are they related, non-related parties? A lot of things to consider. So it's good to have options, I guess.
Always good to have options. And another one for you, Danny. So if I don't have a business, is tax planning still a worthwhile exercise for my personal world?
Yeah, definitely. So especially with regards to strategies like superannuation contributions, with the change in legislations and being able to catch up your contributions, definitely still a strategy for people that aren't business owners. And with personal tax planning, I guess as a part of any investment strategy, again, sort of as Mitch has mentioned with regards to businesses and not one size fits all with structures, I guess it's the same with investments. So when you're looking at a personal investment strategy, there are a few different options there with regards to owning that. So whether you own it in your own name, maybe you own it in joint names, maybe you own it in a trust. There's a lot of different options that are available there. And I guess assessing what your personal cash flow and tax situation is will ultimately determine the best way to structure that investment strategy. So yeah, definitely still important for those that are not self-employed.
Yeah. Nice. And that pretty much wraps up all the questions that I've received. Do you have any last sort of top tips or anything that you'd like to pass on in relation to tax planning or the current environment?
Yeah, I think the key is really don't assume you don't need it. It doesn't hurt to just have a conversation with your accountant about it, and just try and understand what are the opportunities there. As I said, it's always good to have contacts at this time of year anyway. Most of our clients we obviously reach out to, but if there's anyone else out there that needs help or push in the right direction, then we're around.
Yeah.
Yeah, and then from a personal point of view, a lot of people are starting investment strategies with the recent downturn in prices. So having a long-term mindset with that from a tax perspective is definitely something to also consider. So having a discussion with your accountant as well as your financial advisor to get those two strategies aligned can definitely make a big difference with the end result in terms of the tax outcome. So as I sort of mentioned at the start of our discussion, if you have a great investment return but have to give half of it to the taxman, it may not be the best end result. So yeah, definitely consider tax obligations now and in the future, and that's where you can start to nut together the ultimate investment strategy.
Nice. All right. We've really appreciated your time today, guys, and your insights. Thanks everyone for joining us. You will receive an email after this one. If you do have any suggestions or feedback that you'd like to see for future webinars, please do feel free to let us know. Or if you do have any further questions in relation to today's session, again, feel free to let us know when we can be in touch. And just a reminder that next Wednesday, we've got capital raising in a COVID-19 climate. And then the Thursday, the 4th, we've got On the Culture Couch with Paul Roos and Jerry Murphy. And then Wednesday, the 10th, we've got Estate Planning for a Secure Future. So if there's anything else that we can help you with or that you'd like to hear about, please don't hesitate to be in touch. Awesome. Well, have a great afternoon, everyone. And thanks so much for joining us.
Thanks, Joe. Thanks, everyone.